Investor in Big Short Michael Burry issues a recession alert and warns the U.S. economy. The U.S. economy is about to enter a recession that cannot be stopped and will probably last for years, according to Michael Burry. The U.S. economy will see a multi-year collapse, said Big Short investor Michael Burry. What strategy will pull us out of this real recession, he said in a now-deleted tweet on the 9th of December. What forces could pull us so? There are none, so we're really looking at an extended multi-year recession. What exactly is he talking about when he says he's referring to forces? Is the Federal Reserve, the nation's main bank, going to be able to return to its original 0% lending rate? Is quantitative easing going to be possible once more? The truth is that they can and probably will, but the difficulty is that this won't matter if the Fed switches to zero interest rates soon, because monetary lags can strike the economy with a delay of up to 12 months or longer. They're also bringing back fiscal stimulus, and because that resulted in a significant amount of inflation, you can probably assume that legislators' desire to bring back significant rounds of fiscal stimulus is likely diminished. He's claiming that there are no other options because of this. Let's look into why he thinks so. The Big Short. Michael Burry became a trusted brand as a result of the 2008 financial crisis, one of the worst financial disasters in history. In financial circles, it made him one of the role models to imitate while going against the grain. The 2015 movie The Big Short details how the investor, who had little prior knowledge of real estate and banking, came to realize that the industry had turned into a sandcastle, with financiers and bankers producing exotic products based on mortgages issued to financially precarious households and borrowers with bad credit. Therefore, he made the decision to wager on the subprime mortgage market's demise, earning the name Big Short. And history supported his prediction. He had reservations about financial things that other people regarded with enthusiasm. Before making an investment, he prefers to complete his research and comprehend the details. He became a legend. Burry, who currently oversees the hedge firm Scion Asset Management, emerged from the crisis as a sort of anti-hero. He benefited financially from the hopes and savings of millions of Americans who had their houses foreclosed because they were unable to make their mortgage payments. Now the major short investor appears to be arguing that the Federal Reserve and the U.S. government have limited viable options. Policymakers, as he has repeatedly charged, fueled inflation during the pandemic by pumping money into the economy at an unprecedented rate, and he cautioned that this could make it harder and more expensive to promote growth in the future, especially if done. Therefore, the risk we face here is that if we do implement yet another significant fiscal stimulus package, if the economy enters a recession, it might result in extremely high inflation. However, if policymakers are unwilling to take that step, it may result in a significant amount of inflation. They don't want to imply hyperinflation, but it could. Burry has been expecting a recession for some time, and in June he remarked that Americans are saving less as a result of rising costs and interest rates. Are more workers likely to nearly deplete their savings by Christmas? These developments pose a threat to company profitability, consumer spending, and the economy as a whole because it is a major issue when consumers run out of money. After all, our economy is driven by consumers. Without consumption, there's no economic expansion. Prepping up for a downturn. Michael Burry suggests that all of that stimulus is running out quickly and that nothing is left in the tank to reverse the situation this time. Who is making this prediction? There are none, he claimed, and the economy will decline. Burry's assertion that he's the only one preparing for a downturn has at least one expert having serious doubts. And that was NIU Stern economist Nouriel Roubini, with whom we have previously discussed this, who tweeted, "Some of us have been predicting a long and severe recession and made a detailed case for why we're headed towards a great stagflationary debt crisis." Of course, we'll fix that because stagflation rarely occurs when there is widespread unemployment. Because this time around, the unemployed won't have more money to spend, you're more likely to experience deflation, and there's already growing evidence in the data today that the labor market is slowing down, possibly too quickly. Construction employment is undoubtedly declining, but manufacturing jobs are also drastically declining. We predicted that this would occur since the collapse of new orders would result in job losses in the manufacturing industry. Moving forward, we observe a decline in financial activities, information technology, and professional and business services. You may better imagine that many of those are part-time work, especially in the leisure and hospitality sector, as well as in education and health services. Therefore, strong growth there does not portend strong future economic growth, because the manufacturing industry, a significant contributor to employment and growth, is expressing distress. In fact, new data released recently indicates that the situation is even worse than initially believed. The Purchasing Managers Index, or Chicago PMI, printed 37.2 versus 47 for expectation, a major miss to the downside. dropping to its lowest level since the peak of COVID lockdowns in 2020. This slide to COVID lockdown low shouts recession. That was lower than the 25 analysts surveyed lowest estimate, and we want to emphasize that this print can be consistent with the bottom of recessions. That is a serious warning. Burry states that the current recession will last for several years for this reason. Because policymakers are unable to respond to high inflation without fiscal or monetary comments, and if you take a second to pause after hearing this information, you might note that previous recessions have reached similar levels. What does that mean when we discover there is no solution and the economy is actually in far worse condition in the upcoming months or into the following year? We are aware that the business barometer declined more quickly. Prices paid increased more slowly, indicating that inflation may have peaked. When you take a look at this, you can see that the new orders decreased more quickly than demand, which indicates that employment would follow suit, and it did. It dropped more slowly. As demand declines, inventories rise. But note this. The Chicago PMI level has never missed a recession in the past 55 years. Other information released indicates that things are not looking good and are only getting worse. Due to increased rates, U.S. pending home sales decreased for the fifth month. Considering that mortgage rates are currently at 7%, notice how contract signings decreased by 4.6% in October. In turn, this has led to a 36.7% decrease in pending sales from a year ago. This is a startling number considering that Americans are experiencing the worst house buying conditions in at least a generation, which is leading to fewer sales overall. And when surveys indicate that no one wants to buy a home, we've looked at these surveys in previous shows and said, hey, when demand for real estate drops and confidence drops, the headline data will start with them, and indeed, we can see it right now. Considering that homes often go under contract a month or two before they sell, pending home sales are frequently used as a leading indicator of existing home purchases. Of course, we are all aware that not every contract is honored. Additionally, this index is based on a sample that represents roughly 40% of the data from numerous listing services each month. And in the graph, we can see that pending home sales in red are outpacing both existing home sales in yellow and sales of newly built single-family homes in blue. We therefore have a very strong indicator that the real estate sector, which once more accounts for 20% of the economy, is headed substantially lower. What does Powell think? In October, job opportunities decreased as the Fed tried to cool the labor markets. According to Powell, the number of job openings available for workers fell from 2 to 1 just a few months ago to 10.3 million for the month, down from 353,000 in September and down from 760,000 a year ago, according to the Job Openings and Labor Turnover Survey, a closely watched indicator of the labor force shortage. Total layoffs and discharges increased by 58,000 to 1.39 million, while separations from the workforce as a whole increased to 5.6 to 8 million. This non-farm payroll report will be made public by the Labor Department. The objective on that is 200,000, but if it misses the negative, the market would also rise on expectations that the Fed will ease up and back off. What Powell thinks will become clear to us in due time. But keep in mind that there are still 2 weeks left, and all indications point to the Fed, as we already know, having gone too far on this one. The country's not likely to experience a prolonged recession, but also there is little the government can do about it.